Good morning and welcome to Unusual Activity powered by FinancialJuice.com with George Avedon and Milton Marmonides. Good morning, folks. This 26th of February 2015. Lots happening this morning. As always, we have very special guest on today, John Carter from SimplerOptions.com, and he'll be on with us in just about 10 minutes or so. And we're looking forward to having a conversation with him. So let's get into certainly a lot of economic activity, a lot of economic news coming in today, and so we will keep an eye on just about everything for you with respect to the macro markets. We'll take a look at the the S&P futures now are more or less flat, down about a half a point at 2109.5. We have crude oil down now by $1.48 at $49.55. We have gold higher by $12.70 at $1,214.20. The 10-year, folks, is now below that 2% at 1.967. We've been watching these yields for quite a few weeks here with respect to the volatility in the treasuries, in the U.S. treasuries specifically. So we'll continue to monitor that. The bigger story here is the U.S. dollar here, folks, higher by 0.709 on the DXY. DXY is the U.S. dollar versus index versus 10 other currencies. The euro down decently here at 1.1248, lower by 0.0114. So continuing to keep an eye on that rather closely. So what we'd like to do is take a look at where we were yesterday in the U.S. And we'll we'll jump into that yesterday. The Dow Jones Industrial Average lower by 0.08%. Excuse me, finished the day at 18,224.57. Again, in rather impressive territory here. All eyes on, certainly, maybe heading into record territory here. So keeping an eye on that. S&P 500 was lower by 0.08% at 2113.86. The Nasdaq lower by 0.02 at 4967.14. So again, that's something that we're continuing to take a look at. If we take it, let's jump into what we're keeping an eye on, the geopolitical side of things, and certainly, folks, certainly. Keeping an eye on geopolitical in the Middle East, specifically on ISIS, ISIL, and any specific headlines that are coming out from the Middle East with respect to ISIS, ISIL. So sometimes headlines affect markets, sometimes they do not, and that's something that we are keeping an eye on rather closely with respect to those type of headlines. What kind of is there a particular headline that will impact markets with respect to ISIS, ISIL? It's a tough question. When we see these headlines come through, really it seems as though if it's specific countries, if it's counter terrorism actions, they tend to have a little bit more impact on overall macro indices. But again, something to keep an eye on. Also out of the Middle East, keeping an eye on OPEC and Saudi Arabia specifically, as oil seems to be, at least for the shorter term here, we have at $49.55. So within that 50 range, can we maintain that for a bit of time? And that's something we'll discuss with John Carter in a bit as well. Also, we'll move on to other geopolitical events. Certainly, keeping an eye on the Russian-Ukraine situation, and of course the Greek situation, the debt. A bit of a drama going on there, kind of an everyday headlines. But again, still waiting to see if there's any concrete resolution out of Europe, and also with, as we mentioned, on Ukraine and Russia. What type of can the ceasefire hold? Can and what the response from the EU will be with that. So let's jump into what's making news from a macroeconomic perspective. Yesterday, we had Draghi commenting that QE to continue. We're paraphrasing here, but really watching this inflation expectation, they want the inflation expectation to be met before QE stops. So that's something that we're, again, keeping an eye on rather closely. Conversely, here in the U.S., Bullard commenting that ready to get started with rate hikes. Certainly, this is following the Janet Yellen's information from testimony yesterday and the day before, and from the Senate and the House here in the U.S., and that's something that to be followed in the markets. If there's a follow-through on consensus with respect to rates, and certainly more Fed speakers to come, so we're going to keep an eye on that rather closely. This morning in the U.S., we had some interesting economic data come through. Baltic Dry Index higher by 1.7%. At 533 initial jobs claims, we had 313,000, and that is expected was 290,000. Continuing claims, 2.945. Expected was 2.394. CPI, that's the larger story here, lower by 0.7% versus the expected lower by 0.6%. Again, previous revision was to 0.3 negative. So again, we've been mentioning that oil may have an impact on CPI, and that's something that we will keep an eye on rather closely. This morning, we're also anticipating FHFA House Price Index. We'll report on that. We'll give you that information in just a moment. EIA natural gas report at 10:30. Kansas City Fed Manufacturing Index at 11. And Dennis Lockhart speaking at 12:40 p.m. So again, the Fed speaker should seeing if there's going to be any specific information with respect to rates and its effect on macroeconomic perception, if you will. So let's get into some of the more the themes of the day. We have certainly continued euro volatility, dollar strength, of course. We have continued oil volatility as well. We're wanting to hear if there's any, in the Fed speakers and also in other central bankers, if there's any particular conversation with deflation risk and the inflation expectations. Certainly the continuation with the Greek drama and the ECB. Treasury yield curve, certainly keeping an eye on that. And the Russian economy certainly is back in focus. We want to see what the relationship with Russia and the EU as this can the ceasefire continue. Certainly we're coming to a close in the earnings season, so that's something we will continue monitoring rather closely. So as we're preparing for the markets, let's take a look at the oil and commodity markets this morning. We have crude oil lower by 49, lower by $1.30 at $49.68. Gold higher by $12 at $1,213.40. We have gasoline lower by 0.0124 at 1.9043. Natural gas is lower by 0.059 at 2.804. We're seeing if it can come up to that $3 range. Heating oil lower by 0.0326 at 1.9087. Keeping an eye on silver, maintaining that below $17 range, higher by 0.266 at $16.74.5. Cocoa lower by $5 at $29.54. As we said, we're also keeping a very close eye on the yields. We have the 5-year Treasury 1.486, the 10-year 1.971, and we have the 30-year at 2.569. So that's something that we will continue to take a look at. So, folks, without further ado, we're very pleased and glad to have with us this morning John Carter from simpleroptions.com with us on Unusual Activity. John, thank you so much for joining us this morning.
Good morning, George. Thank you for having me. Great to be here.
Wonderful. John, first and foremost, tell us a little bit about yourself, some background, what you do, and then we'll jump into what we're seeing this morning from both a short-term and a long-term.
Sure. The condensed, very short version is that I grew up in the household of a stockbroker, and when I was 18, he showed me how to start trading. I never wanted to be a broker. I never worked on Wall Street, but I was always fascinated with the markets. And so to this day, gosh, here we are, umpteen years, decades later, and this is just what I love to do. And I've learned the hard way the nuances of how the markets work, why things happen and different things like that. And I was a history major, and to me, the markets are fascinating because they tell the tale of what's really going on in the world. The headlines and stuff like that, a lot of times they don't really know what's going on. They're just guessing, but the markets are telling you what's going on, and that to me is fascinating.
Right. Absolutely. John, tell us what you basically concentrate on a daily basis. Let's start off from there. What do you like to, what kind of, do you look at, macro type information? Do you monitor technical analysis as well? Give us a little bit of a feel of what you do on a daily basis.
Sure. As I'm doing even right now, I like to. Sure. The first thing I like to do is take a look at the bigger asset classes. Okay, great. What is the dollar doing? What are other currencies doing? What is oil doing? Gold doing? And then the bonds, and then how is that impacting the stocks? And I just kind of like to see what the tug of war is for that particular day.
Got it. No, absolutely. So John, can we start off from a little bit of a more macro approach, if you will? So January was rather volatile, right? We had some significant volatility. Let's go macro first and say, do you anticipate volatility to continue into 2015?
The answer to that is yes, but not in the stock market. So what I'm looking at is that the stock market, we're going to see a little bit more of the same, where the VIX is. Here's what's happening is that the U.S. dollar is going higher for a reason, and it's because the Fed wants the dollar higher. And the bigger picture of this is that the reason they want it higher is because other countries around the world are starting to have to go into quantitative easing, i.e. ECB. Japan's obviously going to continue it. And what's going to happen is that's going to cause all this money that's being created has to find a home, And with a strong dollar, the only home for all that money that's liquid is essentially U.S. assets. And that's going to continue to push U.S. stocks higher. It'll continue to push U.S. real estate higher. I'm not saying it's going to end well, but if we, by understanding what's going on here, we'll understand what then has to happen. And so we're going to see money flowing into stocks and money flowing into U.S. dollars.
Sure. So let me ask you something. So yesterday we had Draghi commenting that basically QE to continue. We had certainly Yellen commenting. Would you say that was a more dovish testimony, if you will? Certainly, I thought she was a bit coy at times. Well, not coy in terms of rates at times, but is that your perception as well?
My perception is that everybody remembers 2008 and how close we really were to a financial meltdown, right. And they would rather err on the side of being too dovish than hawkish. And I think it's going to actually take a lot for them to finally say, you know what, we need to raise rates. Because technically they should be doing that by now, but the fact that they're not just means that we're going to keep this machine going for as long as we can.
Sure. Okay. I have to tell you, I mean, we tend to agree with that. I think the shock from 2008, 2009, again being super macro here, was so intense that I think most central bankers out there do not want to repeat that anywhere close to that. So I think, let me ask you, are you also looking at the, what's your perception on this deflation risk? It seems as though the term deflation has entered the lexicon of a lot of central bankers. Is this something that you're keeping an eye on rather closely?
Yes, I think there is more deflation risk than inflation risk. One of the things that I watch, the easiest thing to watch for that, I can pull up a chart here, is the 30-year bonds. And if you look at the 30-year bond, so my chart on the left there has right up through here, you're going to see this huge move in the 30-year bond, from the beginning of 2014 to now. And, recently, if we look at a daily chart here, yeah, there's been some selling, but here's the bottom line. As long as bonds are trending higher, and even with the recent selling, they're still trending higher, but as long as they're trending higher, it's because the market, it knows that there's deflationary risk. The only way, when there starts to be dangers of inflation, we're going to see it first in the bond market, and it'll be because the bond market broke this uptrend. Until then, deflation is the core enemy.
So, do you also, in addition to the 30-year bond, again, it tends to be, on the more volatile side of the curve. Do you also watch the 10-year as well? Do you also look at the curve, the yield curve as well? Is that something that you're keeping an eye on?
I do look at that. For me, the 30-year bond I like it because it is volatile and because it's going to react the fastest. Mm-hmm. So I do keep an eye on that. 10-year notes as well. And the yield curve, I mean, once you get to a point where essentially if short-term and long-term rates, especially if they go inverted, it's telling you to prepare, because what's happening is that there's not going to be enough cash available for people that want it, and so people are going to start curtailing spending, and things are going to slow down. And so that is definitely, that is something I like to keep an eye on too.
Absolutely, and it's something that we've been mentioning over the last several weeks is the yield curve compared to about a year ago. So that's, and it hasn't really entered the, interesting, certainly central bankers like to talk about their topics, but, we feel that that's kind of an important thing that hasn't really been brought up hugely as of late, but something that we're keeping an eye on, on that yield curve, especially compared to about a year ago or so. We mentioned offline a little bit on discussing the U.S. dollar. The U.S. dollar has just been, even if you take a look at from middle of last year, has just been on a tear. what's your perception of this, and also, and perhaps a follow-up question, at some point the strong US dollar is going to have an effect on the multinationals. So what are you seeing from the US dollar going into March, and what's on your mind as you're watching the US dollar?
Well, I got really bullish on the U.S. dollar when I've been. One of the things I always like to watch is this squeeze, and once this went to the upside, I was looking. It's like this is going to mean like wow, 8 to 10 months of higher prices. And what I thought is by the end of this run, by June, the dollar would be at 95. Okay, but we've already hit that. We hit that in January. So I'm just kind of looking at that as like I think the dollar is actually going to go back to. I think the dollar and the euro are going to actually get to parity. This strong dollar though is right now in the short term it's good for the U.S. And but after about 6 months to a year or so, and it's really good for large cap companies that get most of their income from U.S. based consumers.
Right.
But you hit the nail on the head that there at some point the multinationals are going to start feeling the pinch. And I think overall that we're going to see kind of a shakier stock market because we're going to see like stocks like energy companies having a hard time, whereas Walmart's of the world, Walmart's going to kill it, and that's going to offset each other a little bit.
Right. No, we tend to agree with you. This is something that, unfortunately is just not discussed too much, but we actually had a guest some time ago as well mentioning that perhaps this quarter will be the quarter that we see an effect from that U.S. dollar strength. Is that your perception as well? Can we see Q2 or next? I'm sorry. The next round of earnings, will we see finally that effect of the strength of the U.S. dollar?
I'm
not sure. Folks, we're just having some technical difficulty, so just bear with us just for a moment. We'll get John back in a little bit. Let's take a look at where we are in the S&P 500 futures in the morning here. So we're just about a little over 7 minutes before the open. S&P futures here are lower by one handle at 2109.25. We have the crude oil, West Texas Intermediate, lower by $1.40 at $49.60. So again, keeping a very close eye on that. Some volatility did come in right around that 8:45 time, shortly after that. Dollar moving up, and a bit of time after we saw those economics numbers come through. We have the 10-year at 1.971, and the 30-year, as John's been mentioning, at 2.569. Excuse me. Sorry, folks. So we have also silver at $16.75. John, welcome back. We have John. Folks, thanks for your patience with this technical difficulty. We have John Carter back from Simpler Options. John, sorry we lost you there for a couple of minutes there. When you get a moment to set up, we'll get John back here. We're just having a quick check of the markets this morning as we're about a little over 5 minutes to go here. Where we have the U.S. dollar 94.859, higher by 0.646, and the euro at 1.1260, lower by 0.0102. John, you were talking about the U.S. dollar, and did I hear you right? Are you expecting parity from U.S. dollar-euro relationship?
Let me see. Is this working okay? Or?
Yeah, we're good. Yeah, yes, absolutely.
Okay, so this is good now?
Yeah, we're good.
All right, I had to, for some reason that microphone just kind of went out on me, so I had to switch to a different microphone here.
No problem. Thanks, John. John, you were talking about the U.S. dollar. Did I hear you right that you're expecting parity?
I am. I'm expecting that at some point this year we're going to be able to travel in the U.S., be able to travel to Europe and exchange $1 for €1, and I'm excited about that because it obviously makes it cheaper to visit Europe.
That's right.
Bigger picture though, as the euro gets cheaper, it's going to make, the U.S. is going to have to battle that because essentially, if you're making your currency cheaper, you're exporting deflation, and that will catch up. But in the short term, yeah, I'm looking for that for sure.
Sure, absolutely. So, and we know that the fact that there's QE in place from the ECB, we know that the objective is for the EU, well, the ECB to bring down the euro, as you said, and you're not alone. Several large banks have basically said, we're looking at parity as well. Societe Generale also commenting that we should see that. Now, you're expecting that this year? Is that this year? Is there any significant levels? Let's get into the technicals a bit. What type of, how far off is that? Are you seeing that towards the end of the year in the euro? Let's bring in some technical analysis here. Or will we just see a precipitous decline in the euro?
Well, I'm looking on the euro right now, and if you see here, like on the monthly chart, obviously we've had a pretty big run to the downside. We've been consolidating for like the last month or so, but I'm looking for the next drop to take us into the 105 area. So it'll kind of stair step its way. It's kind of a move like this right here, but yeah, you can see on a daily chart here. I mean, my gosh, this is a super bearish pattern. Yeah. We've been building up energy, and we're about to release that energy to the downside.
Cool. Tell us, what other macro indicators do you like to watch on a daily basis or more regular basis, if you will, in addition to the U.S. dollar?
Well, the one right here, I've had to me, I call it the schizophrenic market right now is gold, and gold, obviously with a strong dollar, is going to kind of continue working its way lower. But on a day like today, where I see gold's up $12, I see that gold is right now probably has the most tug of war going, where you have people in countries buying gold as a safe haven, yet it's falling against the dollar. So that one's kind of an interesting one. But also, I think the most important oil to watch most important market to watch right now is oil. And the big question is oil's decline done? I don't think it is. And it's interesting. The 2008 financial crisis was triggered by $1 trillion in subprime mortgage loans. Well, the banking industry has $5.4 trillion worth of loans out to the oil industry. And if oil takes a nosedive again, and I think it will, and starts trading like $35, we could actually start seeing not only obviously weakness in energy companies, but the financials taking a nosedive as well, as that exposure becomes relevant. So there's oil right now, to me, is the most important, because if it stabilizes here, that's one thing. I actually think this thing's going to roll over, and then it's going to cause more chaos.
John, it's very poignant. We talk about oil on a daily basis. Analysts galore, pundits. OPEC. Do you listen for, or do you include in your model, what's rhetoric from OPEC or emergency meetings, or are you purely technical, specifically on oil?
It's mostly technical. I mean,
Okay.
the chart doesn't lie, but I also like to look at supplies. Or,
Sure.
how much supply of oil is out there, and there's a record amount, and that's been, the U.S. has been stockpiling it, and you could just watch. So it's like, wow, there is more. It was interesting because this was happening even here when oil was at $100. The
Yes.
supply was getting to record levels. So fundamentally, you could see that, but technically, once it broke, at that point, you just play the trend until it ends.
Right. No, John, you bring up a great point. Years ago, when again, oil was higher, obviously. There was I was listening to a program, and there we have the Bell in New York, S&P futures at 2110.00, lower by about a half a handle coming into the market. We have oil at $49.71, lower by $1.28. John, one of the things that I remember very distinctly is I remember an oil trader commenting that even when oil was high, he said, you can't swing a bat without hitting a barrel of oil. I think that the fact that the supply is a big factor. I think what we bring up on constantly is this, and what you brought up just now is the producer here in the U.S. in addition to OPEC, non-OPEC nations. How closely are you watching? The earnings coming out from the shale producers and commentary from them when you're factoring in oil?
So I spend most of my time. So I'm in Texas, and
Okay.
I spend a lot of time watching shale-based stuff. So
Cool.
Eagle Ford Shale is close to where I live. I you want to always focus on your niche, right? So my
Sure.
experience in the oil industry is I will trade oil futures, but I do not invest in rigs or anything like that. But
Right.
I have a lot of friends who do.
Okay.
And what's fascinating is that they, right now, I mean, they're capping the wells. They want to leave the oil in the ground, and they'll bring it back out again when it gets to 80. And the people that have been doing this for a long time, they've been through these cycles before. They know it could be 5 years. So they're
Right.
fine. We're going to leave our money in the ground. But the people who got in, late, like, hey, okay, now suddenly they're, the classic case in San Antonio right now is somebody who had a job, maybe they inherited a little bit of land, and now they got $250,000 a year coming in from oil. Well, when oil drops from $100 to 50, it's not that their income is cut in half; their income disappears. And these are folks that thought that this income was going to be there forever, and now it's gone. So they're defaulting on loans. They're having to find a job. Horror upon horror. And the joke right now in San Antonio is that you can get a Bentley for cheap if you're in the market for it. And so that's something that's going to trickle through the economy as well. Lots of oil jobs being lost, a lot of people that are dependent on that income being lost. And so I really keep an eye on that. That Eagle Ford Shale, it's close here in Texas, and that'll kind of also give a macro view of anybody who's dependent. Vladimir Putin, he's dependent on oil income. How is he dealing with that?
Correct. And let me ask you something. So this, initially it was, some folks thought that it was going to be a bit of a call it a V recovery, where we have that dip and coming out for oil. Clearly, we're not seeing that, right? Clearly, we're seeing oil sustain its low price here, right? So let me ask you this. You talk to a lot of folks, specifically, in the oil business. At what point will we see hemorrhaging, or your opinion, will we see hemorrhaging in the oil names? Because I'm not sure if we've seen a huge amount yet, but you mentioned there's a huge amount of debt. Banks are holding on to debt. of oil producers. What's your thought? How far out do we need to go before we see a little bit of hemorrhaging there?
Well, the ones that are having the biggest problem right now, of course, are the drillers. So they're the ones that operate on the most leverage. So here's a chart of, I just call it rig. That's the symbol,
Sure.
and you can see that, boy, those things are getting hammered versus something like ExxonMobil, which is obviously selling off, but is able to handle this a lot better because they've got other revenue streams. And so it's what I'm looking for is that the drillers, there's going to be some financial disasters this year.
Okay.
There's going to be countries that are companies that essentially get bought out because they have to be. It's like this thing's about to go under. What's interesting is that there are some companies like LNG. This company is defying the odds. I mean, this is purely they just work with energy. And look at this; it's amazing. So there are companies out there that have great balance sheets, and at some point, if oil kind of turns around, I think we'll take off. But most of the companies out there that are leveraged are going to have a hard time because most of them are also banking on the conversations that they're having is, when oil gets back to 80, and so they're assuming that's going to happen sooner rather than later. My question is what happens if it happens later? And I think that's what's going to happen. I think that we are going to be. I think oil's finding a new trading range. It'll be between about $35 and $55 a barrel for some time to come, and companies have not prepared for that.
Yeah, no, we tend to agree with you. I mean, we're always looking on a daily basis. When we speak offline, is a reason for oil to come up, and that's something I think you bring up a good point, and that is what would make oil come up at this point, both from a technical perspective, from a fundamental perspective, OPEC, anything that's on your radar that you're looking for. They say, hey, I think this may be a catalyst for oil going above that 55 level, as you mentioned.
Honestly, to me, at this point, I think it's a pipe dream. I mean, I think it's something that is really what's going to have to happen is more and more wells come offline. And I know in the U.S. There are wells being shut down, and it's going to take a while for not only the supply of oil to stop flowing as much, but then all the surplus to be used up. The biggest problem is that in OPEC and countries like Russia, Saudi Arabia, their budgets are based on $100 oil or $80 oil, and they especially somebody like Putin, if he's gonna keep pumping oil to make up for those losses because he wants to keep the budgets in place, he wants to stay in power. So right now that's the problem, is that there's no incentive to gradually reduce production. They're doing it here in the U.S., but I think in other places around the world they're going to keep pumping that oil, and that's going to cause more and more issues.
Yeah. Are there any drillers, producers, specific oil names that you're keeping an eye on outside of the just the West Texas Intermediate that you're keeping an eye on your radar? Any specific companies that, hey, they may either get, as you said, maybe get gobbled up by larger companies, or quite maybe in an unfortunate situation, the bankruptcy situation. Anything that you're keeping an eye on? Any particular companies that would be on your list of keep an eye on these guys?
The ones that I've been actually most interested are the ones that are actually holding up the best, and it's like EOG. This is EOG Resources. This is big here in the shale business, and compared to the price of oil, they're actually holding up really well. And this is the kind of company that could go out and acquire other companies, or once oil stabilizes and bounces, would have a nice. This is the kind of, it's like a cleansing where the companies that survive this will come out of it stronger, and I think this is the type of company that would fit that.
Sure. No, that's great. Let's dive into, you clearly trade options. Let's go a little bit of different direction, if you would. On the option trading side, what do you trade, or do you advise? Do you teach option trading specifically for more macro type indices, or do you get involved in option trading on specific equities? What do you like to concentrate on?
Even though I'm fascinated by macroeconomic stuff, I am a short-term options trader. I like to take advantage of things like theta decay. Here's an example. I mean, this is a
Sure.
trade I'm in right now
Okay.
where I like Priceline going a little bit higher. So great. Yesterday we sold some of these 1250, 1240 put spreads. Today Priceline's up about another $4. Great. That's $1,600 in premium. Here's a debit. I mean, these are kind of low risk trades, and that's the kind of stuff that I think is fun because once you understand options, and once you understand how options work and how this is one we put on yesterday, the 272 half, 262 half put credit spread on LinkedIn, you can take advantage of it. And a lot of times people think, oh, I like gold, I think I'll buy some calls on GLD, which is the worst way to do it. And so I love taking the knowledge of, okay, this is what the markets are doing, and this is how options work. Let's combine that for the best of both worlds.
I think you bring up a really good point here. So, in an environment like this, where it seems as though volatility's coming in a little bit, how do you decide to get into a particular option? What do you look for? Specific, signals for yourself, on individual securities. What do you look for? How do you begin to establish a position for yourself?
Well, I'll show you. So the one we did yesterday in LinkedIn, it's more technical, but it's also understanding money flows and things like that.
Sure.
And I'm a big fan of markets that consolidate. It just represents a building up of energy. So if we look at LinkedIn here, we had earnings, and now we've been consolidating. And typically on something like this, what happens is the market consolidates and then continues on its path upward, versus something like this where it's like, oh, it came down to the moving averages and tested support. No, in this case, it's so strong that the moving averages are being forced to come up to it, and that's a very, very strong technical pattern. And I love because you don't know exactly when it's going to go higher. I love selling premium on something like this, i.e., selling puts, because as long as it's going sideways, you're going to make money selling puts, and obviously, if it goes higher, you're going to make more money. If you buy calls, what happens is a lot of times people will buy calls and it trades sideways and you lose money because the premium portion there. So as long as you really get an idea of how the premium works,
Right.
You can do so many fun things with options. And I think it's I think anybody who's not trading options is leaving a lot of money on the table.
No doubt, no doubt. A lot of the option traders that we speak with, as you have stated, is they sell some sell vol, right? So if they see volatility entering the equity and obviously in the derivative, they'll sell that particular call, if you will, grab the premium, and those folks that are buying the call, obviously it's not going to work out, right? So is that something that you include in your strategy as well?
Yeah, the thing is too is it's just important to know. There are times when it's okay to buy options, but it's only about 20% of the time.
Right.
The rest of the time, the 80% of the time, you should be selling premium. But the thing is that the idea, there's the saying that options expire worthless if they're one standard deviation away 70% of the time. Well, guess what? 30% of the time, they are going to be do something pretty major, and you just want to understand the different situations. And so again, like 80% of the time I'm selling premium, but then there is that 2 times out of 10 where I'm a buyer of options.
Got it. Do you also include, and for our listeners and viewers, do you also include the Greeks in your trading, or how do you approach that?
I do, but I keep it really simple. I don't think you have to go too. I've got another guy here in the office. He spends his day looking at Vega and Gamma and everything, and I'm kind of more, let's focus on the implied volatility and then which option to get. So I don't spend too much time on the Greeks, but you do want to have a general sense of kind of what they represent.
Sure, absolutely. And typically, John, give us an idea of how long do you typically hold a position? Let's say you're selling, like you said earlier, the Priceline. You're selling the put spread. Um, uh, Excuse me. With the put spread, how long do you typically hold on to that position?
Anywhere from a couple days to a couple weeks is my sweet spot. There's
Okay.
a more conservative approach is to sell stuff 60 days out and buy it back 30 days out. To me, that's a little too boring. But 2 days to 2 weeks is my kind of fun zone.
Okay. Got it. Um, Anything on that? Any? Again, you don't have to give away the farm forgive the statement, but anything that with respect to option trading, any other equities that's on your radar, and their respective derivatives that you'd like to keep an eye on, especially as it seems as though volatility is coming in a little bit. Anything that's on your radar with in terms of future positions?
Well, in terms of one of the things I've just been watching here in the stock market, just in general, and I'm a big believer in hedging as well. Like right now, it's like, okay, so we're getting close to, well, gosh, it's still kind of far away. I keep watching this upward channel that we've got on the Nasdaq, and I do think that we can get to the top of that upward channel. And I'm keeping an eye on this because this is something where as people kind of pile into this and not really pay attention to this stuff, this is where kind of the next downturn could come, and that's going to create a lot of volatility. Right now, every time there's a sell-off, everybody thinks it's the top. It's kind of hilarious. It's like, oh, this can't last, this can't last, this is the top. And when I hear that kind of stuff, I'm like, wow, this thing's going to keep on going. And I'm a closet bear. It's hard for me to be excited about the long side. But this
Okay.
is, I think we're going to enter like the speculative phase of the markets. And we go back to, if we look at the Nasdaq here, and if we all, if we were trading in 1999, if
Hmm.
anybody that was trading during that time,
Sure,
um,
sure.
we're going to go and take out, we're going to take out those highs, which is insane, and we're going to go up to, if you look at this, I mean, that's a
Right.
pretty bullish chart. We're about to take it out and, look at like 5,500 to 6,000, and I think that it's going to happen. No one's going to believe it. They're going to be fighting it, and that's just going to add more fuel to the fire.
Yeah, John, you bring up a point. Yesterday, we were talking that from a timing perspective, the February March was the high in 2000. So that is rather amazing. That in terms of just calendar wise, we're very close to that as well. And certainly being around that time and trading during that time, rather amazing. And I think the fact that we're coming up to that level again in the Nasdaq is rather astonishing, from a pure macro perspective. Um, so as we head into the final minutes of the show today, what else is on your radar? Anything on a macro perspective that you're watching out for? Anything on a technical level that you would like to bring up in terms of it may change the course of the market, may change perception of the market. You mentioned you're a closet bear. Anything that's on your radar that would bring up, say, perhaps it's not that good.
The only other thing I keep an eye on here too is the yen, and we want to remember that essentially, as long as dollar yen here is going higher, and of course the yen futures are inverse, so if they're going lower, that is essentially good for stocks. So I just like to keep an eye on this. Are at a level on dollar yen where if we get through this, I think there's going to be like a short, kind of a frantic buying in terms of this currency, and the stock market will just continue to go higher. So this is the level I've been watching. We could get some.
Folks, bear with us as a little bit of a technical difficulty again. We apologize for this, folks. So as we're concluding our show here, folks, this has been John Carter on simpleroptions.com. You can find John on Financial Juice in the news settings under educators. Again, John Carter from simpleroptions.com. John, thank you so much for joining us today. Folks, this has been Unusual Activity powered by financialjuice.com with George Avedon and Milton Marmonides. We thank you for joining us. Have a great day and wishing you good hunting.